Okay, so let's try some of these. All right. So if what we let me just write a problem for you. Oh my gosh, I just wrote a magic marker. What if I gave you this? I'd like it. I tell you, I'd like to know how much I should invest. Problem like that. Or I tell you how much do I think I sold a piece of equipment for? Or I bought a piece of equipment for. Right? So I'd like to know how much something's worth now. How much would I have to invest now in these future cash flows? And let's say my future value, some number of periods from now, is $100,000. This is straight up of any quiz I'd ever given you guys. Let's say I tell you the interest rate is 8%. And let me say the number of periods is 5 years from now. Okay? 5 periods. Okay? That's all that matters. Calculate the present value for it. What would you do? What would you do for this? I want to take the interest out of the $100,000, right? To figure out how much I would invest now so that when I earn 8% and I compound every year for 5 years, I have $100,000. That's all I want to do. So how would you set this up? How would you compound interest if you're going the other way? Wouldn't you take your present value times 1 plus the interest rate raised to the number of periods? Right? Because you get your interest every period and there'd be interest on the interest. What are you going to do if you are calculating present value? Instead of compounding, I'm discounting, which means what? I'm going to divide year after year after year after year, period after period after period after period. And the way we write that, you guys, is I would take the future value, set it up right like this. This future value, in this case, the future value is 5 periods from now, right? N is 5 periods. Everybody got it? I know that's $100,000. Okay? And I'd like to know what it's worth now. Present value at time 0. You can set it up right like this. There's nothing to it. Okay? So I'm going to discount. So I'm going to take it 1 times 1 divided by 1 plus the interest rate, raised to the number of periods. Okay? So what am I saying? I'm dividing by 1 plus the interest rate over and over, right? Everybody knows when you take a number times 1 over a number, that you're really dividing by the number, right? Everybody knows this, right? No problem. You know that from your grade school math classes. Okay? So 1 over, what did I say, 8% raised to 5 periods. This isn't magic, guys. I am taking interest out, compound 5 periods, right? Discounting it for 5 periods, reverse the process, at 8% interest. For any interest rate, I can set it up like this. For any number of periods, I can set it up like this. For any future value, I can set it up like this. Who cares what they are? Do you care if it's $1,286,392.12 instead of $100,000? Of course not. What difference would it make? Calculator doesn't care. Tables don't care. Do you care if the number of periods is 5 or 300? Not really. Well, if you use the tables, you would want to have that back. But I'll give you things around the tables. Okay? But it doesn't matter for the calculation, does it? Does it matter if the interest rate is 8% or 0.085392? Nobody cares. It doesn't matter. The computer doesn't care. Calculator doesn't care. Just relax and calculate it, okay? I'm not going to give you things like that. But if it isn't working out perfectly, so what? Okay? All right, anyway, or simple math, I guess. So what would you do? If you want to use your calculator, you can. You can put in 1 over 1.08 and raise it to the 5th, and you get a factor. What is that, by the way? Don't take it down to the 100,000 yet. What is 1 over 1.08 raised to the 5th? What's this factor? That'd be a factor. It's called, by the way, we're going to call this a present value factor. And you can use the tables in this class, it'll be fine. Okay? I like to use the table so you can see what's happening. In real life, I never use the table, I use Excel. You can't see what's happening. Transfer. So then you're tempted to memorize, huh? Instead of knowing what you're doing. If you know what you're doing here, you got it made. The pieces you have to know is, how do I find present value, future value, interest rate, number of periods? I got to know what I already know. in order to solve what I don't know. So I need to figure out what the problem is asking me for. Same in real life. Okay, so what is that factor? Somebody did it? 6805. And a bunch more. Okay, 0.6805. What's worth 68 cents? $1 received 5 periods from now, discounted at 8%. If you invested 68 cents at 8% interest for 5 periods, what would it grow to? $1. Let's say that again. You've got to know this, you guys. You have to have it intuitively. Don't memorize this stuff. I will destroy you on this stuff. And there's a whole lot of other points in this class. A whole bunch. Because business people have to know this. You got to know how to do present values and future values. You just have to. Or other people will take all of your wealth away from you. Or the company you're working for, they'll take all their wealth away from them. And you won't be working anymore. Because you made a ridiculous deal. Okay? So always think about the time value of money. I offered this young woman over here $1 million. For next year, sounds real good until you find out you don't get paid forever, right? Even 20 years from now, that wouldn't be a good deal, much less the 100 I offered it, right? Okay, it's still not a good deal. You can calculate that. It's not a good wage. And it's hard to get your head around that, right? When I started working, I made $9,600 a year. Now it's $50,000. Do you guys think in those terms? Nobody does, right? I don't either, right? I know it because it's historically happened, huh? But it's meaningless, right? Do you know what 50,000 is now? Sure. 10 years from now, will 50,000 be the same thing? No. And that's just inflation. That's not earnings beyond that, right? Okay. So this is kind of hard to get your head around. It's not really totally intuitive. So you got to get it that way. So anyway, if each dollar is worth 68 cents, what do you think all of them are worth? How about $100,000 times 68 cents each? That's all we're doing. So this is 68,000 and $50. It's not exactly that, is it? We need to keep all the decimal places. Take a look on your tables. Okay, let's use the tables. What table do I want? This is a lump sum, 100,000. I want a present value factor for a sum. So present value of the dollar is on page A1 in your book. Appendix A1. Go to the 8% column. Go down to 5 periods, and what package do you get? 6806 actually. 0.6806. We should have really had more decimals. But you got the idea? The computer wouldn't round up. Right? Your calculator won't round up. It'll give you a more exact answer. Could you make that calculation? Nothing to it, right? So if it's in a story problem, you remember story problems? You're doing math in 8th grade or 7th grade or something. The 8 of these story problems, they throw you crazy because you know how to do it exactly. If they just set up the formula perfect for you, all you got to do is calculate it. And then they give you a story problem, you're lost. Life is a story problem. Nobody hands you, here's all the variables stuck in the formula, would you please calculate it for me? If they know how to put the variables in the formula, they got to calculate it or calculate it for them. You got to know what to put into the calculator, don't you? You've got to know what's the present value, what's the future value, what's the interest rate, what's the number of periods. That's the trick. So you're constantly asking yourself that, okay? So let's do another one. Let's think about all right, so let's do another one. Let's say this time my present value is $133,000. I'd like to know the future value some number of periods from now. So we're calculating a future value this time. So that's what I'm looking for. My number of periods is 20. My interest rate is 12%. What did I just ask? If I invest $133,000 right now at 12% interest compounded for 20 periods, right? 20 years, I suppose, right? Well, it doesn't have to be years. It could be every 6 months. It could be quarterly. It could be monthly, right? Okay, so I got 20 periods at 12%. What will that $133,000 grow to? What would you do? Would you take your $133,000 times 1 plus the interest rate to get what it's worth at the end of the next period? Because you get 12% added to it, right? So you want your money back. So it's going to be that future that present value, present value times 0 is 133,000. I'm going to take it times what? 1 plus the interest rate, okay, raised the number of periods. And that's going to give me my future value, that number of periods out there. Well, what do I got? 1 plus what? 12%? Would you agree you want your 133,000 back if you invested? Would you agree that you want 12% interest for every period? Would you agree that you want interest on the interest, so it's going to compound? Sure, right? All common sense. What's in, you guys? 20. That's it. This is a fairly high interest rate, 12%. 20 periods is a lot of periods. It's going to be a big number, isn't it? Okay? So what happens? If you want, you can go look at the table. Let's do that first, and then we'll calculate it too. Okay? So which table? Future value of $1. Oh, by the way, how do you know which one you're doing? I know the present value. I am calculating the future value. So what kind of table do I want? Future value table. Everybody got it? You won't grab the wrong one. Plus, don't you think the future value is more than the present value? If I go to the present value table, I'm going to get a number less than 1, of course, right? Because I'm taking interest out. If I go to the future value table, I'm going to get a number more than 1 because I'm adding interest. Everybody good? Okay, so pretty straightforward. So this is a present value factor, guys. Whoops. Way to go, Keith. This is a future value factor. Right? Future value of a sum factor. Okay? So I want the future value of $1, huh? What is that factor? Future value of $1. On table A3, it looks like. I want 12%, right? Go to the 12% column, right? And down to 20, 9.6463. 9.6463. What is that? So $1 will grow to at 12% interest in 20 years. If you put money, stock market earns 12 to 13% over time. Look at the last 30, 40 years. 30, 40 years. 30, 12%. So if you put $1 in the stock market 20 years ago, about where would it be now? About 10, maybe. Really? Really? You want to invest, you guys? Oh, yeah. We don't want to retire. We want to own anything. Investment. Okay. Don't make payments. You make payments, you make somebody else rich. Invest. Okay.
Does it matter where, like, how much we round to what decimal point?
I would use whatever in the table. Why not?
So, like, 4.
I had to use the 9.6463.
Oh.
Not in the table. I use whatever they have in the table. Why not? And then I'd round to pennies.
We're allowed to use the tables for the test.
Oh, yeah. You can use tables for the test. Yes, or you can use your calculator. Absolutely. Okay, bring your book for the quiz and test. And you can use the tables. I'll try to remember to have the problems only use these few interest rates. Either that or I'll get you. Okay. All right. So each one of those dollars grows to $9.65. If you invested $1, at the end of the year you'd have $1.12. In fact, take a look at that future value table. At the end of the year, what would you have at 12% interest? 1 year, what would it be? $1.12. Then if you invested $1.12 for a year, you'd earn about 13 cents interest. Does that make sense? And you'd have $1.25. And then if you invest that for a year, you get about 15 cents interest, and you're up to $1.40. Everybody got the idea? Then you leave it another year, 157. You can see what's happening in these tables. Okay? And look what happens when you get into those later years. It goes crazy, doesn't it? Obviously, they didn't show 10 through 20. Right? But it grows faster and faster and faster because you have more interest you're getting interest on. Simple. Okay? So, yeah. So, but I don't have $1 invested. I have 133,000. So if each one of those dollars is going to grow to 965, what would you do? Take the 133,000 times 9.65 or 6463, and what do you have? What's it going to grow to? Come on, you guys. Tomorrow's the quiz. Come on. 956.
At 98 cents.
Okay, 957. Okay, yeah. Got it? Could you do this for me? Deal, huh? Not really a big deal at all. Okay? So that's my future value. We just calculated that, too. Okay, guys? All right. Well, let's do something a little different. Oh, by the way, does it make any difference what the present value is, what the interest rate is, what the number of periods is? No, no, who cares? I got a question for you. What if I said that I compounded semi-annually? That's what we're going to do in the next chapter. What would you do if this did semi-annual? 40. You have 40 periods, wouldn't you? It's not 20. You know how many semi-annual periods are 20 years, you guys? It's 2 a year. It's 40. What would you do with the interest rate you used for discount? That's 12% for a year. Interest rates are always stated per year. I already told you guys that, huh? So if it's 12% a year and it says it's semi-annual, what's the interest rate you discount? 6. It's just 6%, right? 40 periods. Let's do monthly. It's monthly. It's like compound monthly. 12% annual interest rate. 20 years. How many months in 20 years? 240. Take 12 times the 20, it's 240, right? And what's the interest rate? If it's 12% a year, what is it per month? 1%. You can do this, can't you? Let's do quarterly. What's the interest rate? 3% divided by 4. What's the number of periods? Quarterly. 4. 8. Yes. Right? 4 times 1. You guys can all do this too. That's not going to bother you. What are you going to have to do, though, to not screw these problems up? Read carefully. How long is it going to take you to actually do the math? A few seconds. What if you do the math using the wrong factors? You get the wrong answer. Why do my students in intermediate who all know how to do this, why do they have an average of 10.5 on this quiz? They all know how to do these calculations. They didn't read the problems carefully. They didn't understand what's going on. And I made it a convoluted math too, so you had to really think about what was going on to find it. But I bet you anything they did not write down PV equals FV, N equals, N equals, and I equals, and find the 3 they knew so that they could figure out what I was asking. Because I didn't directly ask them. Right? Life doesn't directly ask. You're the expert when you go out there to work. Oh, no. They're going to say, I don't know what's going on, will you fix it for me? You ever hire somebody to fix your car, and you say, I know exactly what's wrong, and I know exactly what you need to do, so let me tell you exactly what you need to do to fix it for me. Or does it just quit running, and you ask them to fix it, because you don't have a clue? Which way does this work? It's always like that, right? It's always like that. You don't know. When you go to the doctor, you don't know exactly what surgery you need, or anything that's wrong with you, or whatever. You don't know. You guys got to be professionals out there. You got to know what you're doing, okay? Also, will people really know which is the better deal? If somebody offered you $133,000 right now, or $1 million 20 years from now, and you think the interest rate on that should be 12%, which is a better deal? $133,000 now, or $1 million 20 years from now? 133 now, absolutely, because you could invest it at 12% and turn it into 1.3 million. Why would you take 1 million? It's worth 1.3. This is valuable. Now you think of the average person, if you told them they had $1 million, what would they say?
Give it to me.
Oh yeah, well, I want $1 million, I don't want 133,000. Great, I'll do that. I'll make a lot of money. Right? I get to keep the 282,956 for me, right? No risk investment. Excellent. Okay? And you just gave it. You're happy. That's like the students tell me that the present value is more than the future value. I always say, what? Can we do business with each other? You'll pay me to borrow money from you? That's great. I'll pay you. People don't go quite that far, but they get close. Okay? Ridiculous things. Okay. Let's try an interest rate. Let's see if you can do this. See how close we can get on this. Whoops. Okay, let's say I know the present value times 0 is $100,000. The future value, some number of periods from now, is $200,000. Let's make the number of periods be 5. I'd like to know the interest rate now. Could you do that? You do, you guys. If you have a calculator, it's really easy. You tell it the present value, the future value, the number of periods, and you ask it to solve for the interest rate, and boom, it comes out. If you don't, we can still approximate it with the tables. Okay? But what is the process here? You can set it up either way. You could either go present value now is 100,000 times some future value factor. That's future value of some, and equals a future value some number of periods from now, and that number of periods from now, of course, is 5, isn't it? Okay, so this is going to be times 1 plus some interest rate that I don't know, raised to the 5th, is 200,000 future value 5 years from now. It's true, isn't it? It's true that everything I know is solved for what I don't know. What I don't know is the interest rate. Anybody calculated? Plug in your calculator yet? By the way, if you don't know how to do this with your calculator, get your book out that came with the calculator. Of course, you don't have it anymore. You lost it, right? As you always do. But if you go online, what can you do? Find your calculator and find the instructions for it. It's really easy. Go to the company's website and make your calculator. Plug in your calculator, ask for the instructions, and find out how to use it. It's in your financial functions. Okay? If you have a calculator that does present value and future values, it'll also be this close. Okay? All right. So what's I here? We could solve for it, right, mathematically. Actually, though, we're going to do that pretty much. What is the factor? Let's calculate the factor. 100 into 200 is what? 2.0. Would everybody agree that's a factor of 2.0? It's got to be. 100 times 2 is the 200, right? I just divided the 100 in to get there. Everybody agree with that? Okay? And I'm going to use a future value table because I calculated a future value factor. So let's go to a future value to sum table, and let's go to 5 periods, and let's see if we can find 2.0. Okay? So it's going to be, I use the future value. I'm going to go to 5 periods and go across until I find 2.0. Where about is that? 15%. Yeah, it's between 14 and 15, very close to 15. So that's what I said. It's close to 15. Everybody see it? About 15%. Did somebody calculate with their calculator? Do you know how to do that? Nobody did it. I don't know how to do it yet. It'd be nice if you what are you going to put to your calculator, by the way? The present value is 100. The future value is 200. The number of periods is 5, and you ask it to solve for the interest rate. They're all a little different, so, right? But that's all you're doing. Solve for interest. Okay? And it'll crank out some number, 14.9 something, probably. Okay? But you could use the table too, couldn't you? I got real close there, just pulling the number out here. Do you see the 2.0 among you guys? Under 15% on table A3. 5 years. I just went down to 5 years and went across. Everybody went with me on this, right? You won't have a prayer tomorrow if you can't do this. Okay? Or the next day. Or in the final. You gotta be able to do this. I'm showing you how right now. Do it. Look at it. Right? Think about it. Are you going to assume you know how to do this, or are you going to practice somehow? Practice. Okay. Anyway, so you see the 2 there? It's in the 15% column, isn't it? So this is about 15% interest. Double your money in 5 years at 15% interest. That's right. Okay? But how much risk do you take to get 15% interest? A lot. What's risk-free right now, you suppose? If you want to invest in government treasury bonds, risk-free, for 5 years, it's only a couple percent. 2 to 3%. Wow. 15? What's that? Risk-free, by the way, includes the true return plus expected inflation. You talked about. So what's the risk of this thing? Huge. It's a huge risk. But nobody money. By the way, the stock is 12%, so this is a lot more risk than that. 3% is a lot more than the 12. But not over the edge ridiculous. It's not like 25% return or something. Okay, good. So we've got then about 15% here. So it's approximately 15% Okay? Let's do another one. Let's say we had this. My present value times 0 is 100,000. My future value time in is 200,000. My interest rate is 10%. Oh, okay. I'm going to be able to get that. Okay. And I'd like to know the number of periods. Calculate that one. It's not a big deal. What would you do? Set it exactly the same way. And oh, by the way, you can either put the present value on this side and the future value on this side, or you can do the reverse. Okay? So maybe what we'll do is do it that way this time. You can do it either way. Here's the deal. If you put the future value on this side, and you put the present value on this side, that's key. Present value on this side, what am I now calculating? Go in this direction now. I put the 200 over here, little example. Yeah, now I'm discounting it, aren't I? Everybody agree? Now you're discounting it. And if you're discounting it, what kind of a factor do you have? Present value factor for a sum, huh? And I'd say that would be 1 over, when I discount, take the interest out, 1 plus the interest rate raised to the number of periods, wouldn't it? I'm dividing instead. Okay, so you could have set the last one we did up this way too. But now you'd be on what kind of a table? Present value of a sum table, right? What is this factor anyway? It's 0.5, isn't it? 0.5? 0.50? What I've got is 1 over 1.10 raised to some number of periods is 0.5, right? That's what I'm doing, okay? There's what it is. So you could put this in your calculator. You could put present value of 100,000 in, future value of 200,000, interest rate is 10%, and solve for the number of periods. You like it? You can always put in 3 and solve for the 1 field half. Really simple. Learn to use your calculator, right? But then realize what it's doing too, okay? All right, so what can we do instead if we don't have a calculator? No calculator. Or we don't have access to Excel or something. What would you do? Grab a table is fine, okay? And which one do I want? Present value of sum, huh? Take a look at the present value of sum. What do I want to do? What interest rate did I give you? 10%. How about going to the 10% column, and what do I want to go down to? 0.5. What is that approximately? 7. So it's between 7 and how many? 7 and 8. Between 7 and 8. 0.5 is less than 0.51. Goes the opposite direction. So it's between 7 and 8. Closer to 7. And I take between 7 and 8. Did anybody do it with their calculator? You guys don't know how to use your calculator yet, do you? I don't know how to do present values and future values. I came here today, I asked you, and you just looked at me, oh yeah, I got this wired. This is not a big deal. I never worry about this quiz. You know how to do it, do you? Why do we assume we know how to do things we don't know how to do? We all do that all of our lives. It's hilarious, right? Oh yeah, I know how to do that, and I forgot it years ago, right? Go figure it out again, learn it again. Not do it. You can figure anything out though, right? But do you want to do it under pressure of a quiz, figure it out at that moment, or would you maybe like to figure it out before you take the quiz? Yeah, good idea. Let's add an annuity to this. Okay, how does an annuity work? Okay, let's do a simple example. Let's say I've got 3 periods. Okay, I'm going to have 3 periods. So what it's going to be is n is 3 number of periods. Let's make our interest rate be 12%. Okay, and let's say that we have a annuity payment. And it's going to be an ordinary annuity payment. Only ones I'm giving you, right? I said. So this is annuity payment. That means, ordinary means it's the end of each period, okay? End of each period. And let's make the annuity payment be $100,000. And we'll do two different things. We'll calculate the future value of this thing, and we'll calculate the present value, okay? So let's start with the future value. Future value in number of periods from now, and in, of course, is 3 in our little example here, isn't it? Okay, so what I'd like to know is this future value. How about if I gave you this? Two ways you could approach this. What you could do is you could calculate the future value of the first 100,000 and have it grow for 2 years. Why do I say 2 years? That's the hard thing about this annuity thing. You're putting the money at the end of the first year, and you're going to value it at the end of 3. How long do you compound it for? 2 periods. How about the second payment? Then I make it at the end of the second year. It's only going to be there 1 year at the end of the third year. How about the third payment? It gives no interest at all. 0. Right? So we could calculate it that way. Now this is only 3 periods, so we could do all 3 of them and add them up. No big deal. Again, how about if it's 360 of them? No, I don't want to do 360 multiplications. So let's do this calculation the hard way, I guess. Let's do it with all 3 periods. By the way, this is 3 payments of $100,000. What are we calculating the future value of? 100,000 invested or 300,000 invested? There's 3 payments of 100, right? So you guys know what an annuity is now, right? It's 100,000 every period for 3 periods, and the interest rate doesn't change. 12%, got it? And these happen to be at the end of the period because we're going to do ordinary annuities. What would an annuity be, by the way? You make your investments at the beginning of the period. There are some deals like that too, okay? So you go either way, right? All right, so let's value this thing. What would I do? What are my cash flows? At time 1, a year from now, at time 2, right, 2 years from now, and at time 3, 3 years from now, I am going to invest, here's my cash flows, $100,000, and I am going to leave it, right, in the investment until the end of 3 years. Everybody agree? If I was going to calculate the future value of these things, I want the future value at time 3 here. What would I do, you guys? This is easy, isn't it? This one I'm going to compound at 12% interest, 1 plus the interest rate, for how many periods? All right, put the money in at the end of the first year, and so again, I want to know what it's worth at the end of the third. 2 periods. Everybody agree? How about this one? 1 period. So that's 112,000. I can do that one. What's 100 times 1.12 times 1.12? Or times 1.12 squared? Or look on the table for 1.12 for 2 periods, right? Future value sum. What is that? So it's 112 times 1.12. How much was that?
It's 12544. Okay.
And you could look at the future value sum table and 2 periods, you find out when you do 12%. It's 1.2544. It is, isn't it? Okay. How long is this one going to be invested? No time at all. 0 periods. What is 1.12 raised to the 0? Remember this stuff? It's not 0. It's 1. 1, right? 1.12 raised to the nothing is 1, right? What do we got? 100 times 1. What do I get? Okay, it's just a 1. Okay. This is 100,000. That's it. What's the total thing worth? What's it worth in the future? What's it going to grow to? I got no interest on the last payment. I got 1 year's interest on the payment before that, and I got 2 years interest on the payment before that, right? How long they're sitting there. So you got to figure out how long it's going to be invested. You do it this way. It's a pain. Okay, so what do those add up to? Come on, you guys.
337,440.
337,440. How much interest would you have earned? You know, you invested 300,000 and you have 337. 37,440. Right, guys? If I ask you how much interest you earned, give me that. Celebrate. Give me that. I give you extra points for doing that. Okay, nice deal. So that is my future value at the end of 3 years, isn't it? If I add all 3 of them together. Now let me ask you this, just take a look at this. Would it be okay with you if we add together the three factors here and only multiply once? Could I take, there's three payments, right? Could I take the $100,000? This is another way you could calculate it, which is infinitely superior, you guys. This is the annuity payment. So I got an ordinary annuity payment. Always keep track of what you're dealing with. There are three of them, right? Three payments. How much am I valuing? $300,000. Everybody agree? So if I calculate it this way, fine. It's still the same $300,000, right? In total. And what I'm going to do is I'm going to take that $100,000 times these three factors added together. So let's take a look at the future value of a sum table. Future value of a dollar, table A3. Let's go to the 12% column and let's add up the first future value sum. Let's add up the first three there. Add up 1.0 plus 1.12 plus 1.2544. What does all that add up to? Yeah, what? 3.3744? It does, doesn't it? Oh, it's a remarkable number, isn't it? So what I'm going to do is I'm going to add those three together. And I'm going to take so these three added together is 3.3744. That's three factors added together, gang. Do you see it? Oh, well, what if I take that times 100,000? What do I get? 337,440. So even on this problem, of course it's the same. Even on this problem, it saved me time, didn't it? Instead of doing three multiplications and adding them up, I do one multiplication and I'm done. Okay? Again, imagine 360 payments. Much better, much better. Okay. You know what this thing's called right here? This is the future value of an ordinary annuity factor. What they've done for us is added them together in a table. So instead of us adding those three together, we can just go to the table and find it. So what I'm going to do is I'm going to look for the interest rate, 12%. The number of periods is 3, and I'm going to go find that factor. And it's pretty easy. Look at the future value of an annuity. It's really an ordinary annuity. You might want to even write that in your book. In your book, I guess. Future value of an ordinary annuity of $1, right? Look at that 12% column. What is the factor for 3 periods? 3.3744. They just added the other table up for you. Actually, we use a formula, so it's a little more accurate, right? The formula adds them up for you. Oh, big deal, right? You know what you do. Okay? You just got to get on the right table. So, yeah, you just calculate this thing, no problem. And what is this over here? If this is the present value, right? The present value of the payment is 100,000 each period, right? So that ordinary annuity payment is like the present value the way we're doing it here, huh? Okay, it's 3 of them though. And then this is the annuity factor, right? Future value annuity factor. This is the future value at the end of 3 periods. There's just nothing to it, okay? Now how about though if we wanted to get the present value? Let's do exactly the same thing, but let's get the present value instead, okay? By the way, you can do interest rates the way we did the interest rate with the table, with annuities too. And you do the number of periods with annuities too. It doesn't make any difference. You do exactly the same process we did, right? With using a lump sum. Oh, so once you know how to do it, you know how to do it. You got to make it, okay? All right, so what did I say? I want to calculate now the present value. Okay, so let's calculate this. Let's set a future value, some number of periods from now. Let's make it, whoops, I don't want future value. Okay. If I knew that, I wouldn't have this problem with it. Okay, let's say I have an ordinary annuity payment. It's ordinary because it is when, guys? End of the period. So let's say it's 20,000 at the end of each period. let's set an interest rate, I don't know. Do you have 13% there? Yeah, okay, let's do 13%, and let's say the number of periods is, you have 15? No, 10, goes to 10 to 20, ridiculous tables. Okay, all right. By the way, why do these tables exist? We should mention that. Nobody needs these tables anymore with computers and calculators. They exist because we didn't used to have them. Really? When I first started college, a computer that could do far less than your phone would maybe fit in a room this size. And cost, I don't know, millions. Really, right? So the capacity we have is just amazing. The problem is our brains can't keep up. We can't compute as fast, right? And we can't see what it's doing because the computers, I don't mean computers are smarter than us, they haven't created anything yet, right? Original thoughts yet, okay? They start doing that, I guess we're totally obsolete, okay? Apparently they can't feel anything yet and all that stuff, right? At least we like we're done, okay? But there were no computers, so what they did was for a whole bunch of different interest rates, you name it, right? Lots and lots of different interest rates, not on even percentages, even like an 1/8 of a percent, 1/16 of a percent, and then all kinds of different numbers of periods. We have these books, and they're like tissue paper in the book. No kidding, I've seen them, they never had to use them, luckily. But calculators works. Electronic calculators were a big thing when it started. 47 years. Okay, really? They can't help with computers. Okay, so, but anyway, they had these tables that were like tissue paper, and you put a piece of paper behind it so that you could read it, and it was every interest rate you could imagine, every number of periods you could imagine, in shelves full of books, right? And that's how people did it. Wonderful to be rid of that, huh? But now what's the problem? You've got to know what you're doing, huh? Even more so. You can't see what you're doing, okay? So anyway, if I wanted to know the present value of this thing, what am I valuing here, you guys? Always do that. What's the total amount I'm going to value it? It's an annuity payment of $20,000, and there's 10 periods. How much is that? It's $200,000. I am calculating the present value of $200,000 received out in the future, right? Do you think the present value is more or less than $200,000? I think it's less. Okay, so you at least have that check on it, don't you? Right? And the interest rate is 13%. That's pretty high. I bet it's a lot less. And you're getting the payments when? At the end of each period. So this time you are going to be discounting the first payment. How much? 13% for one period. The second payment? 13% for two periods. Third one, 13% for three periods. The 20th one, 13% for 20 periods. Take a look at the present value of the sum table. And go to the 13% column. Present value of the sum on table A1. Go to 13% and go down to 20 periods. What's that last payment going to be worth with 20%? Or did I do 10? I did 10. Go down to 10, okay? What is the factor of 12%? 32 cents. The last dollar you receive, each one of those dollars, right? The last $20, yeah. The last payment is going to be worth what? 32 cents each. You got it? Oh, was that 12? So 29.5 cents, maybe. Get in the right column, huh? Okay, so 29.46 cents, right? The last, you buy this? Why is that true? Because if I invest 29 cents at 13% interest, it will grow to $1 compounded for 10 years. Everybody got it? What's going on here? So we're just taking the interest out, no big deal. But on this one, do you want to do, would you like to do 10 calculations here and then add them together? No, so I'm not going to do that. What I'm going to do instead is I'm going to go look up a present value of an ordinary annuity factor. So we got a table for that too, don't we? Present value of an annuity is at the bottom of the same page, only we won 13%, so it's at the top of the next page, I guess. And how many periods did we won? 10, so what's the factor? 5.4262. If you add together the 10 factors for the present value of the sum, there, the table before that, what would they add up to approximately? 542. Everybody got it? 543? There's nothing to this. What's worth $5.43? $10 received $1 at the end of each period for 10 periods, all discounted at 13% interest. How much interest would there be, seeing as $10 is only worth $5? Whatever that was. $5.43. How much interest?
$4.57.
You got it. 457. 10 less that. On every single dollar. You got it, guys? 7. $10. Okay, so what I'm going to do is I'm going to say, all right, fine. My ordinary annuity payment is $20,000. And like we said, that's $200,000 in total. Okay, so we know what we're doing. I'm going to take that times what? I want to know its present value, you guys. Present value of an ordinary annuity factor. Or you can, students in intermediate sometimes ask me, well, can I just use the formula? And the answer is, of course you can. Why not? Kids that are good at math, if they're good at math, they did rather just use the formula. Fine, I don't care. Okay? So, what do we got? What is that factor again?
5.4262.
So, that's what? Present value of an ordinary annuity payment, or factor rather. Interest rate 13%. Remember what we're doing here. Number of periods 10. So I'm going to go to that table, right? Present value of an ordinary annuity. And I'm going to go to the 13% column, and I'm going to go down to 10 payments, and I got the 5.4262. Can everybody do that? It's not a big deal. Okay. So what's worth 542 again? $10. $1 received at the end of each period for 10 periods, but I don't get $1 each time. How much do I get each time? 20,000. So if I take 20,000 times 5.4262, how much is that?
138,524.
Wow. You mean this 200,000 I'm going to receive in the future is only worth 108,544 right now? Yeah. And the difference is the interest. Right? About $92,000. Everybody good? At 13%. That's all we're doing. Is this any different than if I took 20,000 times each factor for the 10 years and then added all 10 up? No, it's going to be really, really close with a little rounding, right? This is more accurate. Okay? That's the deal. If how much would you be willing to invest if you wanted to earn 13% interest and you were going to receive 20,000 at the end of each year for 10 years? How much would you invest now to get that 20,000 later if you wanted 13% interest? 108,544 because that's what it's worth. If I put 108,544 in an account that earns 13% interest, I could take out 20,000 at the end of each period, right? And have nothing left at the end. And I will have earned 13% interest. That's what we're doing. Okay. This is really valuable. Question?
What are the last three numbers of that?
544. 108, 544.
It's actually 524.
Oh. I trusted you guys.
Okay, so it is 524. And then also, I put it on my calculator and it ended up in negative. Is that,
Then you hit a key wrong. I bet you did.
is it always positive?
Yeah.
No,
Well,
negative?
unless you started with a negative, maybe you told it that 20,000 is negative, cash out,
Is it?
and then it would be negative.
No, mine did the same thing. I plug in all of these and it keeps sending it in negatives for some reason. Like it's the right.
It's assuming you're doing cash out, I guess. Must be. But no, it's not negative, is it?
No.
No, it's got to be positive. Wouldn't it be nice if somebody gave me 108 and then later paid me 200? I don't think so. But what it's assuming is cash out now. The present value is cash out now to get those future cash flows. I bet you that's what you're calculating. Every one of them's a little different. But that would make sense. But don't put a negative sign on it when you give it to me. No. Okay. It's not a negative. A negative net present value means that when you discount those future cash flows and you have cash payments going out too, right? You end up with a negative net present value, which means you earn less than the particular interest rate. Don't worry about that later. Okay? All right, gang? So could you do all of these? Not a particularly big deal?
One of the examples we did, the number was like in between two numbers, and then I checked it and it was like 2,000 off probably. So how much like leeway would we probably have in place?
Oh, if I give you, if I'm having you calculate an interest rate or something like that,
Yes.
I'll give you lots of leeway. If you use the table, you get a different answer than if you use the calculator.
Okay. Yeah, because
And if you're just estimating the interest rates, you can just tell me it's between 7 and 8%, close to 8 or something like that.
okay.
Slightly less than 8, slightly more than 8, whatever. Okay, give you an answer like that. You don't have to try it. There's something called interpolation where we can estimate it, but nobody bothers with that anymore because everybody has a calculator and can tell you exactly what it is.
Okay.
Right? So when we were solving for the interest rate or solving for the number of periods, if you use your calculator, it's going to tell you it'll be 5.135 years, something like that. You know what I mean? And they will get it exactly. Good question. Okay. So did you guys work any of the problems? You're supposed to be out of time now, but we can keep going for those who want to stay. We could work some problems from the quiz, maybe, or from the homework, either way. Or we can make one up, whatever you guys want to do.
What's the review for the test?
The review for the test is tomorrow from 1:15 to 3:15.
1:15 to 3:15?
Yep. And I would assume this room will be open, if it's not, we'll find some later. So that way you do your quiz, rest a little while, come back. Work a couple more hours. Fine. So you got some questions you want to work? Particular one?
This is from depreciation though.
Oh, okay.
E8-3, just the third one.
E8-3.
Yeah, it's on page 420. Because in the chapter it says that land doesn't get depreciated.
Yeah, you don't appreciate that.
But then this it has like land, building, transfer costs. So that was just kind of confusing.
Page 423,
At the bottom.
E8.
That's right.
Dash 3. Okay, they bought a building for $82,000 cash and land which is located for $107,000 cash. Okay, so both are cash. So $189,000. The company paid transfer costs of $9,000, $3,000 for the building, and $6,000 for the land. Renovation costs of the building for $21,000. Give journal entry for the purchase of property, including all expenditures. Assume that all transactions were for cash and all purchases occurred at the start of the year. So, yeah, you're not going to depreciate the building, the land, rather. You're going to depreciate the building. What are you going to do with these transaction costs to acquire, transfer costs to acquire? When I'm buying that acquisition cost, what do you do with the building? What do you debit with it? I'm going to credit cash for the full amount, right? I'm going to credit cash for 82 plus 107 plus 9, I guess. Right? How much is that?
198, that's fine.
Yeah, I'm going to credit cash for 198. I think so. I agree with you.
Then when you do the renovation entry,
Oh, we got to do that one too. So how much was the renovation? Was it cash too?
21,000. It doesn't say, but I guess.
Okay, yeah, cash or different payables of some kind. Fine. Huh. So what are you going to do?
List. What I did, I listed all three of those expenses first.
Expenses?
I debit building 82, land 107, transfer expense 9.
Transfer expense. Is that what it is?
I don't know. That's what they had it as. Did you say acquisition?
He said acquisition cost. What's an acquisition cost? Oh, is acquisition cost an expense? He thinks it's an expense. Transfer expense. It's an expense. What are expenses? Costs I incur to generate revenue. So I have an expense that I'm trying to generate revenues this period, and that's an expense. Really, I don't think so. I think I'm buying a piece of property I'm going to use in the future. What do you do with all the costs associated with buying a piece of property you're going to use in the future?
Use it as property.
It's all part of the property. It's going to be part of the land and building. Ah. Now, you can make it acquisition cost, but then you still have to amortize it or depreciate it over time, right? So it's better just to add it to the building and add it to the land, because the land you're not going to amortize, right, or depreciate, right? The building you are, it's depreciate, right? Equipment, yeah, equipment would depreciate. Ah, so you gotta keep those separate. All right, so, yeah, I think it's all gonna be building or land. I don't think there's any expense here. What would you think acquisition cost is? You came up with that, but what would it be? See, it's gotta be something. It's gotta be an asset. It's gotta be an expense. It's gotta be something.
The building plus the land, no, so it would be.
So how much was the building and the land?
2,000 and 107 for the land.
Okay, 107 for the land. What you add together there? That's what they paid for the land, plus what?
82 for the building.
Well, that doesn't add up to 198, or does it? That doesn't add up. You didn't get there. I got 198 went out, including the 9 transfer costs. If you buy a house, you guys, you pay $200,000 for the house, and then you have to pay $20,000 in fees or $15 in fees for a realtor, you know, for taxes, or, you know, everything associated with getting that title transfer, everything associated with getting that property. You think you paid 200 for it or 220? I think you paid 220. Come on, right? You got to include all the costs. When I was working at Ocean Mushroom Farms, we imported equipment to produce mushrooms from Holland, and it cost us 20% of the purchase price to get it delivered. You think that's an expense, or is it part of the cost of the equipment? Cost of the equipment, yeah. What if you're having a building built? What about the architect's fees? It's part of the building, don't you? Engineering fees, part of the building. I mean, they don't go into the building, right? The materials all go into the building, the labor of putting it together and so on. But any costs associated with it are what? Part of the building. How about if I'm paying interest on a construction loan during the period of construction? That interest is part of the building. What about after it's completed and I'm using the building? Now interest on the building is interest expense. Why? I'm using the building to generate revenues now. Well, I'm building the building, it's cost of building the building. Wow. Okay. How about security, night watch, guarding the construction site? Part of the building. How about night watchman once you start using the building? It's an expense, it's not part of the expense. See the distinction here? So what are those acquisition costs? They're part of the cost of getting it, aren't they? So I don't like those numbers very well. Come on, you guys. What do you think they are? What should we be doing here? How much did you pay for the land? Plus what? So how much is that? 113, I think. What did you pay for the building?
82.
Plus the transfer cost of how much? So it's 85. Now what's 113 plus 85? That's the 198, right? Okay, so far that's where we're at. Then what about this 21,000? What are you doing? You're renovating the building. Is this repair and maintenance expense?
I'm not sure if this is renovation.
It's renovation. You just bought it, but you haven't used it yet, and you're spending a whole bunch of money on it. I think you capitalize it. What if I used it for 10 years and now I'm spending money, you know, painting and putting it in the roof on? It might be repair and maintenance. Unless it makes it into a better property, then what would it be? Then you capitalize it as building. What if it just makes the building last longer? You might debit accumulated depreciation. Remember, I did these last time. Remember that? First half of the class last time? And the author talked about it too. That's what's going on here. So what do we have in this case? We have 21,000 more buildings. And I'm going to depreciate 96,000. And that now answers your question, doesn't it? What do I depreciate? $96,000. What don't I depreciate? And all the rest of it, 130 is land. Why don't I depreciate land? It doesn't go away. Got it? Don't use it up. Okay. So did they ask you the depreciation in the next part?
Yeah.
Okay.
Straight line.
Straight line.
At the end of 1 year, 10 year useful.
1 year.
15,000 residual.
1 year done. Oh, okay. 10-year life. So it's going to be 1/10 of my depreciable value, though, right? So my salvage value or residual value is how much? 15?
15.
So how much are you going to depreciate again? cost is 106 total, is that right? 85 plus 21. Take away my salvage value or residual value of 15. What do I have? Depreciable value is 91,000, is that what that is? Everybody agree? Divided by the life. 10 years. And if it was full year, $9,100. What's the journal entry for that? Always, once we calculate what our depreciation is, what do we do?
Depreciating expense.
You got debit depreciation expense,
Accumulate.
9,100, and credit accumulated depreciation. Is that what the answer key shows? We're brilliant people. Okay? Got it. By the way, could we have done 3 journal entries up here, done 2 for this stuff up here, and then that one? Sure. All right. I'll put it together. Yes, you could have done 1 journal entry for all 3 of them. Tell where you're at. Right? Is that the whole problem? Exercise 83. Oh, what was the net book value of the property, land, and building in year 2? Wow. Okay. What would you do in year 2?
Well, since it's straight line, you just multiply.
Yeah, you do too, right? You do exactly the same journal entry next year, right, guys? Same one. Okay. So what I would have is, do they use property, plant, and equipment instead of land and building?
Just land and building.
Oh, they use one account for land and building?
Well, it says of property and then parentheses.
Oh, it doesn't say, so they didn't tell you if you should split it. I would split it into 2 different accounts, wouldn't you? And then depreciating one and not the other, and on my balance sheet, I want to show them both anyway. So I'd have at least land, building, equipment, 3 different accounts, don't you think? But then on my balance sheet, I might call it property, plant, and equipment and show them one number. Make sense? You do that if you want. Okay, so I've got land. They want to know what we have on land. It's 113,000, right? They want to know what I have on building. How much do I have? 85 plus 21. We said we had 106. On accumulated depreciation on that building, what will I have in? I will have put in 9,100 the first year, and I'll put in 9,100 the second year. So at the end of the second year, what do I have? 18.2, right? And depreciation expense would have been 9,100 each year, and I'd close that to retain equipment, right? So I'm reducing the book value of the building rather every year, and reducing equity, same amount of retained. Okay, so what's 106 less 18.2? That's my net book value, isn't it? How much is that? What's 106 less 18.2? 87.8. So 87,800, is that their answer? Plus the land of 113,000. Okay. Pretty good. Worth doing these, isn't it? Look at them, think about what's going on. What made this hard? What do I do with those acquisition costs? All right. Have you used it yet? No. Must be by the cost of getting it. What do I do with the renovation costs? Have I used it yet? No. Remember I gave you the example of buying a semi, tractor trailer rig last time? It was completely worn out. So we buy it for almost nothing, but then we spend a fortune getting it ready to use. Fortune ready to use and start buying it. Okay. Versus if I buy a piece of equipment and I wreck it the first day, that's a loss, right? It didn't make it a better piece of equipment. I don't have more equipment. I just have a character loss, right? Okay. Versus if I buy it and I use it, and now it's maintaining it in the ordinary course of operations, what's that? Repair and maintenance expense. Versus if I buy it and I use it up a whole bunch, and now I rebuild the engine or refurbish it or something after I use it, right? And I'm going to keep using it. What do? I either debit the equipment, increasing it, right? In this case, debit the building, increasing it. Or if I've been depreciating it and I don't think it makes it a better piece of equipment, I think it's going to make it last longer. What would be a really good idea? Debit accumulated depreciation, reducing it down so I have more to depreciate. That makes sense, guys? No. Well, anything's possible. Tell me what number 7 on the quiz does. We'll try and do it.
And payroll records.
Okay. So what we want to do is record a payroll entry. So I didn't cover anything from liabilities, did I? You know, those miscellaneous accruals. Oh, we already did it. We already did the accruals, deferrals. We did current liabilities earlier. And the author gives you some more examples. But how do you record every single liability? Increase it. How do you increase a liability? Debit or credit? Credit, yeah, it's a liability. You increase it with credit. How do you reduce it? Debit. What do you typically pay your liabilities with? Typically. Tax. Unless it's unearned revenue, and then you satisfy it by delivering the goods or services. And that's pretty much it, isn't it? That's the world we're living with here. So tell me what you know about payroll in that. Which problem? Oh, it's number what off the quiz?
7.
Number 7. Okay. Number 7 on summer quiz. Okay. Anyway, what does it say? Go ahead and read it.
The following data were provided. So compensation wages were 35,000.
Okay, so wages are 35,000.
Income taxes withheld.
Okay, tax withheld. How much is that?
Was 7,350.
What else you got?
And union dues.
How much is that?
175.
375.
175.
17. Anything else?
And then the FICA taxes are at 7.65.
FICA tax. How much?
7.65%.
Oh, 7.65%. All right.
No employees have reached the maximum yet.
All right, so nobody's over the limit, so it's going to be on the entire wages. Okay, so when we say wages, what do we mean? That's the gross pay. Do my employees get 35,000? No. Does it cost me 35,000? Yes. What do? We withhold their federal income tax, right? That's federal income tax withheld, right? So it is. Okay. So we withhold that on their behalf. Whose money is that? It's the employees' money that we are giving to the government on their behalf, right? Their taxes. What happens if you withhold that from their paycheck and you don't send the money to the federal government? You have violated the law and you can go to jail because you stole the money from them, right? That. You always deposit these taxes. You don't say, oh, gee, I'm getting close to bankruptcy, I'm in real trouble. No. You always deposit. Okay, the union dues, they belong to a union, there's a convenience for them, you withhold it from their paycheck, right? And you give it to the union, that's all. So that's a payable to the union, isn't it? So the taxes withheld is payable to the federal government, right? Maybe the state, if there's state taxes too, like in this state, okay? And then union dues, we have city too. And then union dues, that's convenience of the employer, but it's payable to the union. And then the FICA tax, what's that? The employee pays it, so it's withheld, right? Equal to 7.65% of what? Of the 35,000, or if they go over the limit, right? Anybody over the limit, you don't do it anymore, right? The limit is huge, right? Oh, what did they say in the book the limit was? 110. Something like that. So you got to be making quite a bit of money before you go above the limit, right? Okay. Although I saw a thing that suggested that if they raised it to 250,000, Social Security would be in great shape for the next, I don't know, it's 50 years or something. Because wages keep going up, have kept going up, and we haven't raised the limit, right? So high income earners aren't paying as much into Social Security, although they don't take as much out of here, kind of 50% of their income. So yeah, whether you view it as taxes or you view it as a saving for retirement, I guess, right? I view it as taxes personally, is what it is to me. What's 35,000 times 7.65%? How much are we going to withhold? This is going to be the withholding and our expense. How much is that?
$2,677.50.
Okay, all right, everybody got it? I can realize you've been around it, of course. Okay, now, that's the employee's share that's withheld, but then the employer has to match it, don't they? So the tax is really more like 15.3%. Everybody got the idea? 7.65 twice. The employer pays it once, and the employee pays it once. Okay? That's how Social Security works. All right. So we want to record this thing. Did they pay the payroll, or are they just accruing it?
Well, requirement A is prepare the March 31st journal entry to record the payroll and related employee deductions.
Yeah. So we haven't paid them the payroll yet. So what would you do? You got compensation expense, wages and salaries expense, something. Yeah. So wage expense. One way we could go. How much is the wages? 35,000. What do you want to credit? That's a debit, of course, expense, right? Okay. What do you want to credit? We didn't give them cash. We didn't pay it. Wages payable. Okay. If we paid it, we could do cash. That makes sense? So let's go to wages payable. Oh, now you have to know how much you're going to pay them. What are you going to pay them? So 35,000, right? Less the taxes withheld, federal income tax withheld, right? That's federal income tax withheld, I guess. Okay. Less the union dues and less the FICA. Would you guys agree with that? Withheld.
It says that no employee had reached the maximum, so what does that mean again?
What that means is you're going to have the 7.65% on the whole 35,000.
Okay.
That makes sense?
Yeah.
If somebody's over, you don't have it on them. So you'd have to just figure out what portion of the payroll is not, are people not over the limit. So only really high paid employees go over the limit, obviously, right? So if you have employees that are over the limit, then you don't have Social Security tax. Yeah, okay. All right. So wages payable is going to be 35,000 less 7,350, less 175, less 2,678, isn't it? How much is that? What's the payroll going to be that we actually pay the employees?
24,797.
That's it. Okay. Where does the rest go? I owe the federal income tax withheld. Okay. The federal income tax withheld payable is going to be how much? 7,350. The union dues payable. This can't be this easy. What it is. This one's payable to the employees. This one's payable to the federal government. This one's payable to the union. Payable. How much? 175. And then I have one other one, and we might put it in the same account as the federal income tax withheld, right? What's this one? FICA withheld. FICA tax. And this portion is payable. It's withheld. It's payable to the government too. So I can put it in the same account because I'm going to send it to the same people. Does that make sense? You can put together the 7,350 and the 2,678 into one if you want. Does that journal entry balance? You bet it does. We're done. Except there's the employer's share of the FICA. And what's that going to be? The author shows it also as compensation expense, which is okay, but most people show it separately. As what? FICA expense. Social Security taxes paid by the employer. How much? Same 2,678. So how much more do we owe the government? I just add that to the FICA tax payable here, by the way. How much more do I owe? Another 2,678. So I'm going to pay them 7,350 plus 2,678 plus 2,678 when I send the money to the federal government. Okay. What would you do when you pay the payroll? So that's all it asks for, right?
That would then be to give the journal entry to record the employer's FICA payroll tax expense.
So that was this.
Yeah.
Yeah, you got it. Okay. Then is there anything else?
No.
No. Let's add one thing. Let's pay all these bills. Let's pay the payroll. What do you pay them? Cash. I think I credit cash. How much?
35.
No, not 35. It's not the payroll I'm paying.
Oh,
Yeah. Yeah, the 24. 797. And debit what? Wages payable. Does everybody see that one goes away? 24. 797. So what I did was I got rid of this. I paid it off. Keep going. What else would you want to pay off? Taxes, yeah. So let's put them all together into one. Well, no, we could do it this way. FIT, federal income tax payable, right? Withheld payable, and cash. How much was that? Let's go ahead. Let's do them separate. That's okay. That's 7350. Now that liability's gone in there. Everybody see it? You guys know how to pay off liabilities. It's cash, right? Then what? The FICA tax. But what's the FICA tax going to be? So two added together, right? So the FICA tax payable in cash is how much, guys? 2678 times 2, right? Because you have to pay the employer's share and the employee's share. How much is that? 53, 56? We're brilliant people. So now that one's gone. What's left? Anybody want to do the union dues? Union dues payable. 175 in cash. Okay, the only thing I'd like you to notice here is that this isn't any different than other accrual of liabilities we have and paying the liability. Exactly the same process, isn't it? That would be an adjusting journal entry. Those two journal entries, the debit wage expense, the debit FICA expense, and credit all the payables. Those would be adjusting journal entries at the end of an accounting period to make sure we have the expenses all recorded, right, and the liabilities all recorded. You did a whole bunch of accrual entries, didn't you? Same stuff. So once you figure that out, the entries are pretty easier. That was a good one to do because they're all pretty useful as well. Got something else you want to do now? Okay. That quiz looked pretty simple last time. Too easy. You can make it hard. Yeah, well. Hot. They also unplugged this power cord. You found it down in there. Yeah.
Can we do number 12 on the quiz as well?
Sure. You read it, Jimmy.
Yeah.
Number 12 on the quiz.
Says, how much would George have to deposit in the bank at the end of each of the next 5 years if he wishes to have $15,000 in the bank at the end of that time period, assuming she will earn 3% annual rate of return?
Okay, you tell me what things. Well, by the way, what things are we going to look for here?
We need to know how much she has to pay, like.
She's going to make the same payment every time.
Yes.
And the interest rate stays the same. What would you call that? We're looking for a what?
Annuity.
Yeah. I want to know the ordinary annuity payment. Why do I think it's an ordinary one?
That's all we know.
That's all you know how to do, but why do I think it's ordinary from that description?
It's at the end.
It's at the end of the period. Yeah, that's it. So you are looking for this, right? I want the ordinary annuity payments. You already know what you're looking for right away when you're reading it. And then what other pieces of information would you need?
We have the interest rate is 3%.
Sure. Is how much?
3%.
3%. I need an interest rate. What else do I need to know?
The number of periods.
Number of periods, which is also going to be the number of payments, right? In case of an annuity. How many is that? 5. Oh, man, we're good at this already. And then I need one other piece. Either a what or a what? Or future or present value. Either one would be fine. They give me both fine on there, right? Okay. But what do they give me? She'd like to know how much she has 5 years from now, huh? Which is how much? She only wants to have 15,000. Boy, this isn't much of a savings plan. Okay, so $15,000. Okay, something. And she's gonna have, maybe she can buy a car, really expensive. Okay, she's saving for 5 years from now. What? Anyway, so 15,000. Got it. All right. Be better than making a car payment. You own the car, right? Don't pay the So what would we do? How would you set this up? The authors usually divide, I usually multiply, I can care less, I can set it up. You could take the payment, right, equals, here's a way, ordinary annuity payment. I want to know what this ordinary annuity payment is, right? That's what I'm looking for. I do know its future value that I want it to grow to. 5 periods from now, it's going to be 15,000. Just getting myself set up here. Okay, this is going to be a what? Future value of an ordinary annuity I'm calculating, or a present value? Future. So I'm going to go to the table, future value of an ordinary annuity, right? And what interest rate do I want to use? You gave me 3%, and what number of periods do I want to use? So what could you do? You could go to the future value of an ordinary annuity table. You could look at 3% interest, and you could go down until you get to 5 periods. What is that factor? So you don't earn very much interest, do you? What's worth $5.31? $1 invested at the end of each period for 5 periods. On the first dollar, you're going to earn 3% interest for 4 periods. On the second dollar, you're going to earn 3% interest for 3 periods. Then the next one 2, and the next one 1, and the last one none. Right, guys? And when you add up all of those future values, it's going to total up to $5.31. You're not earning much interest because it's only 3% interest, and it's only 5 years, and the deposits are at the end of the period. So I'm not just, everybody good? But anyway, it's better than nothing. So how would I get back to the payment? Some number times that number is that number. Anybody got an idea? Or just divide it. Take the 5.3091 and divide it into 15,000. What do you get? 28. Okay. Now how much will you actually deposit? 5 times 2825. How much is that, you guys? Go ahead and do that. That's 5 payments, right? How much are you going to deposit? How much interest will you earn? This is how much you actually deposit. This is how much you have at the end. How much interest you earn? 875. Yeah. Okay? It's kind of easy. Subset it. Now what the author would have done is they'd have taken this 15,000 over here, and they would divide it by the 53091, and then that equals the 2825. Isn't that what we just did? I just set it up a little differently, that's all. I think you can see it better set up this way. That's why I like to do that. So it's not magic. I'm not going to write the formula. It's just common sense. Yeah.
14,125. What did that stand for again?
That's how much total I'm actually going to invest. If I invest $2,825 each time, and I do it 5 times, it's going to be 5 times $2,825. I'm going to invest $14,125. And then it's going to grow to 15,000. The interest is the difference. That makes sense?
Yeah.
Just common sense, right? What's what? I took 5 times 2825. Remember, it's an annuity, right? That means every period you make a payment, right? We just calculated how much the payment is. It's 2825. And it's every period, no period skipped, so it's 5 periods. That's 5 payments. So when I valued this over here, right, what I'm doing is this factor for 53091 is what $5 grows to. $1 deposit at the end of each period for 5 periods, right? So I'm not depositing just 2,825. I'm depositing 2,825 5 times. Okay. So what's 5 times 2825 is 14,125. Is that getting there? You have to say this to yourself over and over for a while. That's it. Oh, okay, that's what that is. I got it. I know what I'm doing. Annuities seem really magic at first, don't they? How can 825 become 15,000? It doesn't. 14,125 becomes 15,000. That's a lot more credible than a 3% interest for a short period of time. Yeah.
As far as like how you set it up and like what we had or what we didn't have, would the answer would be 2,825.
Yeah.
And then for that second one, you said something different, that wasn't, you just.
Yeah, if I typically don't ask for how much are you in total investing, but I could, right?
Like can you say that again, like how you did it?
It's just taking 5 payments times the payment.
Okay, so it's.
That's all it is.
It's deposited?
That's, well, yeah, what's an ordinary annuity payment? I'm putting money in. If I'm calculating the future value, I'm putting the money in. If I'm calculating the present value, I'm probably taking the money out. Make sense?
Okay, so you asked on the quiz for us to like depreciate a patent.
Yeah, when you don't appreciate it, you amortize.
Okay, so you amortize them, you figure that out just like straight line depreciation.
Yes,
right?
it's just like straight line, only you directly reduce the patent. You debit amortization expense on patent. And you credit patents. Because the patent is really going away.
And what about the
It's
grab?
going away. If it's not going away, you wouldn't amortize. Like goodwill, you don't amortize. Okay, question?
The gravel fund.
Yeah, and that would be depletion
Would you
expense.
debit the inventory and credit depletion?
Well, you could debit inventory and credit accumulated depletion if you're setting it aside to sell it, right?
So that's
You're digging it out of the ground and you're building inventory. How about if I'm delivering it to my customer? Now I got a sale recorded, so it'd be the major costs associated with that sale. Yeah, debit cost of goods sold, credit accumulated depletion, either way.
Could you do with depletion, for depletion expense, would that be wrong? Or-
Yeah, kind of, because you would think it needed to be cost of goods sold if you carved inventory, right? Goods sold, yeah.
And so for the patent, how, like, why does the patent?
It goes away if it's passed for a certain number of years. Either that or you estimate, it might be by law, a certain number of years in your patent. Or you might think it's gonna be obsolete, somebody else is gonna replace the product, maybe you, so you might have a life shortage. But what you can do is you can capitalize the cost of acquiring the patent, what do I mean by capitalize? That an asset.
Yeah.
A patent. And then over its life, you can amortize it straight line. Just because the cost of the patent is the cost you incurred to get the future revenues. That makes sense?
Yeah.
And then you'd amortize it just a straight line over its life, just to try to allocate the cost to those revenues, not to match them up. You get it? Right? It's all the same concept, isn't it? It's just, okay, what are we doing? How are we doing this and why? Good questions.
I did it last night or like midnight, so
It's 7, 8.
I'm gonna go through, just make sure all.
So much work. Terrible.
Oh, I'm not getting that.
It is very mature, that's why.
Oh, it is? That's good. I didn't give you the rules. Okay.
You wanna do it real quick?
Oh, I'm doing it on like I'm using your calculator. Is that
So,
okay?
yeah, you can do the same answers within like a few dollars.
Oh my gosh, it'll help you so much.
It'll be within a few dollars, your calculator's more accurate than the tables. Because the tables are rounded off, your calculator's not.
So how
But
do
you're
you
gonna be
know?
within a couple bucks, always.
Anytime it says like annual rates, and like that means that you have to use the PMT button. But if it just asks for the present value,
No, annual rate means the interest rate.
well, I know that I'm talking about like
Oh, an annuity payment?
I don't know when to solve for either do I solve for PV or PMT.
PMT is payment. So if you're going for an annuity payment, it's PMT, right? But remember, the one we just did, right? You're going for that ordinary year payment. You have to tell it in your calculator if the payment's at the beginning of the period or
Yeah,
the end of the period. Make sure you're telling it it's the end. Our problems.
Are you? I know that I know that you have to switch it if they're gonna pay on the day that it's due.
Yes.
Are you gonna do that?
No, I won't do it. But make sure you have it set in the calculator, right?
I do.
Okay, good. Okay, you know what I mean? You have to have one, I think it's one probably at the end of the period, zero at the beginning, you're supposed to calculate for that. Yeah, whatever, you know, or maybe it's just the beginning, they have it nicer.
Yeah.
Yeah, so payment is getting this payment here. Present value is getting what those future payments are worth. Right? Present value is how much you invest right now to get future payments or to get a future value at the end.
So can I read this to you real quick?
Sure.
It says George's grandmother promises to give him $1,200 at the end of each of the next 10 years. How much is the money worth today? If George could invest the money and earn a 12% annual rate of return.
Okay, what you wanna know is what it's worth today. That's the present value now.
That would be a present value.
Yes, that's what they're asking you to calculate. And you know what the ordinary annuity payment is, right?
Yeah.
They gave you the payment, so you didn't put that as your payment in your calculator. How much is the ordinary annuity payment? What's she gonna give him?
1,200.
1,200 at the end of each year. What's the number of payments?
10,
What's the interest rate?
12.
You got it made. In your calculator, you put in ordinary annuity payment 1,200.
What is that? Is that PMT though?
Yeah, that is PMT.
Okay.
You mean payment. Just a shorthand to your calculator. Okay, PMT payment. And then the N is 10, the number of periods.
And then we're solving for present
I,
value.
the interest is 12, and you're solving for present value right now.
So 6, 7, 8, don't you want?
Yeah.
Okay.
Right.
Now the way you set it up is you're going to use the tables, or even using your calculator, it pays to set it up this way. Okay, it really does. Because if you use the calculator, you're just going blind. You're trying to remember.
All right, on it.
Instead, well, yeah, good. Well, instead you do it like this. My ordinary annuity payment, right, is $1,200, and I know the present value, or I want to know the present value, right? That's what I'm calculating. But I do know I'm going to use a present value of an ordinary annuity factor, or use your calculator, it's just fine. Okay? It's going to be interest rate, 12%. Number of periods is 10. So take a look at the table. Present value of an ordinary annuity, right? I'd do it both ways if I were you.
You want me to look at the table?
I do
That
both.
table confused me last
Yeah, but if the table confuses you, you don't yet know what you're doing. And you're just memorizing what the calculator is doing for you. Don't do that, don't do that, don't do that. You want to know what you're doing, right? You want it to work either way. And then you can use your calculator because it's fast and it's more accurate. But if you don't know what the calculator is doing, it's dangerous. You agree with that? He's really good with formulas. You don't know what the formula is, you just have it memorized. You get me.
What?
Okay, so we're looking for present value of the ordinary annuity, right? That's the only table you have, so. Okay, 12% column, down to 10 periods, what's the factor? This is 10 factors added together, right? Because we're eating 1,210 times, right?
We're looking for the present value.
10 payments. If we're looking for the present value, you need to be on the present value of an annuity table, right? And we're valuing $12,000 here, you guys. Present value is going to be less than 12,000, right? There's 10 payments, 1,200. We're valuing 12,000. Okay. What's that factor? 10 factors added together, right? How much is it?
The factor?
Yeah.
5.6.
What's worth $5.65? $10 received. $1 at the end of each period for 10 periods, and then the interest taken out of it. The interest would be $4.35, right? On that $10 payment stream. Dollar cent. This is 10 factors added together. That's what your calculator is doing for you. Okay. All right. So 1,200 times 5.6502 is what? How much is this worth? Was that 7,800 number you got?
Yeah, it was
7,008 or something like that. Ta-da! See, be able to do it both ways.
Well, I
And
didn't
then
want
you
to
can go ahead and use your calculator, but then you know if the answer is about right or not. Right? Does it make sense?
Can I copy this and bring it with it?
You can use it. Oh, no, you don't, sure.
I just want to make papers.
Absolutely. Copy the pages and bring them in, copy all of them. Right? All the pages in that attention. Okay, gang. Good.